Something just snapped in the global silver market, and most people haven't realized what it means yet. China has suspended silver trading, and when a market this big hits pause, it's never for a small reason. This is not a glitch, not a rumor, and not normal market behavior. This is what happens when pressure builds to a breaking point. If you think last week was chaotic, what's coming next could be far worse. And the people who understand this early will not be the ones panicking later. China doesn't halt trading unless something is seriously wrong. When the world's largest metals consumer freezes silver trading, it sends shockwaves through the entire system. This move instantly raised one dangerous question. What are they trying to stop from happening? Because when trading stops, price discovery stops. And when price discovery stops, panic usually begins somewhere else. While paper markets are frozen in one region, physical buyers don't wait. They rush. This is how panic buying starts quietly before it explodes publicly. And by the time headlines catch up, shelves are already empty. Before we go any further, if you follow silver, gold, or real market signals, like this video and subscribe to Bullion Alert HQ. It helps you stay ahead while others are still reacting. Now let's talk about why this suspension matters so much. China is not just another participant in the silver market. China is a dominant force in industrial silver demand, manufacturing, and global supply chains. When it steps back, the imbalance shows up everywhere. Silver isn't just money, it's an industrial lifeline. It powers solar panels, electronics, medical tech, and advanced manufacturing. Halting trading suggests extreme volatility or a supply stress that officials don't want reflected in prices. That alone should make investors uncomfortable. Here's where it gets more interesting. While trading is suspended, demand doesn't disappear. Factories still need silver, supply chains still need silver. So what happens when official markets freeze but real-world demand continues? Buyers turn to physical channels. This is exactly when premiums start to detach from spot prices. And that's when people realize paper prices don't tell the whole story. Reports are already coming in of increased retail buying across Asia. Dealers are seeing unusual order sizes and faster inventory depletion. This mirrors what happened during previous crisis moments. Trading pauses didn't calm markets, they redirected pressure. Now combine this with what we already saw last week. Massive paper sell-offs followed by explosive physical demand. That pattern is repeating again, but this time with China involved. And that changes everything. When one of the largest players steps away, the rest of the market has to absorb the shock. Often it can't. Silver is a small market compared to gold. It doesn't take much stress to push it into disorder. That's why silver reacts more violently than gold during crises. And that's why suspensions are so dangerous. While mainstream commentary downplays this move, professionals are paying close attention. Silence from officials often speaks louder than statements. What you don't hear, explained on major networks, is why a suspension is needed at all. Markets are supposed to handle volatility. When they don't, it means someone is losing control. Another detail most people are missing is timing. This suspension comes right after historic price swings. It also comes during already strained global supply conditions. That overlap is not accidental. This is when confidence starts to fracture. Once trust in market function weakens, behavior changes fast. People stop asking what price is fair. They start asking if they can get the metal at all. That shift is psychological, and it spreads quickly, especially online. Social media searches for silver buying have already begun to spike. That's often the first visible sign of panic demand forming. Once the average buyer senses scarcity, rational behavior disappears. That's when runs happen. At Bullion Alert HQ, the focus is not fear, it's awareness. Knowing what signals matter before emotions take over. Trading suspensions are never bullish in isolation, but they often precede violent moves in one direction. The market hates uncertainty more than bad news, and right now, uncertainty is everywhere. This brings us to the critical question. What happens when China resumes trading? If prices gap higher, panic spreads globally. If prices gap lower, physical buying may surge even harder. Either way, stability is not the likely outcome. Volatility feeds volatility. The next few days matter more than most people realize. This is where trends are set. And the scariest part is that most investors won't notice until it's already moving. By then, options are limited. This is why watching silver right now is so important. It's acting like a pressure gauge for the entire system. And we're only halfway through this story. Because what's happening outside official markets may be even more important. Stay with me, because part 2 connects China's suspension to physical shortages, global price gaps, and why panic buying could accelerate fast. When China suspends silver trading, the pressure doesn't disappear, it shifts, and where it shifts is usually the physical market. The moment official trading pauses, buyers start looking for certainty. Physical silver becomes the only form that feels real. This is where panic buying quietly begins. Not with headlines, but with empty dealer inventories. People don't wake up panicked, they wake up curious, and curiosity turns into urgency fast. Dealers across Asia are already reporting tighter availability. Some are limiting quantities, others are quietly raising premiums. This is how shortages form before prices move. Supply dries up first, price reacts later. While paper markets stay frozen or volatile, physical demand has no off switch. Factories, investors, and institutions still need metal. Silver isn't optional for modern industry. Solar, electronics, medical tech, and defense don't pause because trading is suspended. This creates a dangerous imbalance. Demand keeps flowing while supply access narrows. When access narrows, people stop waiting for better prices. They buy now. This is why silver shortages often appear after price crashes. Lower prices feel like opportunity, not risk. Combine that mindset with fear of availability, and behavior changes instantly. Rational thinking leaves the room. Another factor pushing this faster is global price gaps. When silver trades higher in one region, metal moves there. If China resumes trading at higher prices, global markets will feel it immediately. Arbitrage doesn't ask permission. If trading resumes lower, physical buyers may accelerate even harder. Either way, calm is unlikely. This is what most analysts get wrong. Volatility doesn't reduce demand, it redirects it. Gold is watching all of this quietly. Historically, gold moves after silver exposes stress. Gold doesn't panic first, it confirms later. Central banks are still accumulating gold in the background. They don't chase dips, they prepare for instability. This tells us something important. Confidence in paper systems is not improving. Once trust starts slipping, it rarely returns smoothly. It breaks in stages. China's suspension is one of those cracks. Small on the surface, massive underneath. Markets function on belief as much as liquidity, and belief is fragile right now. Retail investors may not understand sigma events or trading halts, but they understand scarcity. When people hear sold out, behavior changes instantly. Logic loses to fear. This is why next week could shock many people, not because of one headline, but because of reaction chains. Silver is a small market. It doesn't need much to spiral. Gold is a larger ship, but even large ships turn when currents shift, and the currents are shifting. At Bullion Alert HQ, the goal is to watch signals before they become stories. Trading suspensions are signals. Physical shortages are signals. Premium spikes are signals. If you're watching silver right now, you're watching stress in real time. This isn't theory anymore. Whether prices spike or dip, volatility is almost guaranteed, and volatility is where mistakes are made. This is why staying informed matters more than predicting exact prices. Awareness beats precision. Now I want to hear from you. Do you think China's silver suspension will trigger panic buying globally? Drop your thoughts in the comments below and let's talk it through. Different views help everyone see what's coming. If this breakdown helped you understand what's really happening, share this video with someone who follows silver or gold. These signals matter most before they're obvious. Thanks for watching Bullion Alert HQ. Stay sharp, stay calm, and I'll see you in the next one.